This is PowerPoint 1.7 on the monetary conditions of the late 19th century in the United States, and really I'm offering this as way of amplification. We've talked at some length in previous lectures regarding the strain that's placed on the credit system, and we'll get in just a second to what's causing that strain. We've seen it before. A lot of this is review. I wanted to put, among other things, kind of a numerical example, a real simple numerical example so we understand what's happening. We start off with the basis of the gold standard. If we have $100 and 100 ounces of gold, this is largely derived from the basic economic principle of opportunity cost. To do or to have one thing, you have to give up doing or having something else. Okay, you can either have $100 in paper currency, or you can have 100 ounces of gold. This equivalently makes the $1 is the same as an ounce of gold. Okay, now if the supply of money increase is greater than the supply of gold increase, then the paper currency will drop in value. Okay, so for example, you see here, if we allow the supply of money to go to $200 in paper currency, and gold rises to only 120 ounces, meaning a 100% increase in the paper currency, a 20% increase in the amount of gold, then $1 is now equal to 0.6 ounces of gold rather than 1 ounce of gold, and so the paper currency loses its value. And this is actually, in layman's terms, a very basic principle. The more you have of something, the less valuable each of them is. As we increase the supply of money beyond the increase of the gold supply, the paper currency loses its value. How we finance the Civil War is going to create massive inflation, and this is really where the problems are going to begin. And Lincoln never gets blamed for any of this, but it was largely what started the process was his means of financing the war. He issued greenbacks. Okay, this was effectively paper currency. And so during the Civil War, the United States, the North, largely went on to what's called fiat money, which we'll get into at a much later time. We'll get into that in Epoch 3, meaning that the money itself is basically just an IOU. It's not specifically backed by gold anymore. And so the supply of money skyrockets. You see there, inflation during the war was 76%. After the war, the United States is in a bit of a difficulty, okay, because they need to return to the gold standard, because at this point in history, this is latter part of the 19th century, everyone is on the gold standard. Everyone, Great Britain, France, Spain, everyone, all of the U.S.'s trading partners are on the gold standard, meaning that their currency is backed by gold. When they loan money to the United States, they anticipate that money being backed by gold. Okay? So to restore credibility for the United States and to restore value of the American currency, the United States has to return to the gold standard. Now here's a problem, because during the war, the North, the Southern economy we won't even get into. We talked about it, I think, a little bit during Reconstruction. It was just a complete mess. But during the war, the North massively increased the supply of money. Okay? Well, now that we're going to go back on the gold standard, that's going to create problems, because when you put it back on the gold standard, you're going to have a massive surplus of paper currency vis-a-vis your supply of gold versus your supply of gold. And as a result, the paper currency is not going to be very valuable. This is going to be a problem for creditors that lent the North money during the war, both European creditors and domestic creditors. So what the United States is going to try to do is contract the money supply. Now, this is a serious problem. This is the strain we've been talking about throughout Epoch 1. Okay? Well, hold on here a minute. What did we look at? What did we look at in Lecture 2? What did we look at in Lecture 4? Well, what we looked at in Lecture 2 and Lecture 4 is in Lecture 2, what did we talk about? We talked about Gilded Age. We talked about massive increases in industrial production. Well, that massive economic expansion requires money, okay, to finance it. So, too, you have massive agricultural development. You have massive westward expansion, massive land speculation. All of this requires money. Okay? But to increase the value of the money, they have to contract the supply because they overissued it during the war. Okay? So as a result, at the same time that you're having this massive economic expansion of the late 19th century, you're also trying to contract the money supply. You can't do that. Okay? Something's going to break. Think of it like this. Think of it as a rubber band or a string even. Okay? As you pull it tighter and tighter and tighter as you do with the economic expansion, you're also reducing the size of the rubber band. Okay? Well, eventually the bloody thing's going to break. And that's what's going to happen in 1893. We'll get to that in just a second. Into this mix, we're going to put, now into the gold standard, we're going to put also the other variable, production. Okay? Let's add this to our original model from the first slide. Okay? And we're just offering a little bit of a numerical example. It makes it a little bit easier to see what I'm talking about. We have $100, 100 ounces of gold, 100 units of output, whatever that output may be. Tennis shoes, okay? Probably not in the late 19th century, right? They didn't do tennis shoes. I don't know when the tennis shoe was invented. I should think that it was sometime in the 20th century. I have no idea. Whatever. 100 units of whatever, okay? Well, during the Civil War, we have the supply of money go up greater than the supply of gold, which we saw in a previous slide reduces the value of the money. With the destruction associated with the war, productivity also went down. And so what you have is you have $200 in currency, which we had from the previous slide, 120 ounces of gold. Well, now you have 80 units of production because of the wartime devastation. Well, that means your price is going to go up. This is, as previously mentioned, 76% inflation. Now, you can imagine from that example, and you're free to run numbers all you like all day and all night, okay? Let's hold that supply of money constant. And that's what the last slide said was, okay, we're going to hold that supply of money constant. We're not going to issue more greenbacks. The supply of gold isn't going to go anywhere. The supply of gold, what did we see? We saw in westward expansion that the supply of gold and silver is going to go up modestly. It's going to go up actually precipitously for a while with the gold and silver discoveries, particularly in Colorado and the Dakotas. Okay, and you're going to have a massive increase in production. Well, what we have here is if we increase the supply of money and reduce production, prices go up. Okay, that's how inflation is caused. But what happens if we do the reverse? If we hold the supply of money constant and massively increase production? Well, one would anticipate the reverse taking place. And so what you're going to have in the immediate period is a deflation, prices dropping. And what did we see in presentation 1.4? Well, we saw that through the 19th century, farm prices, both wholesale and retail, precipitously went down, progressively went down the entire period. Well, this is why. The supply of money is being held constant. Their productivity is going up because of land expansion and because of productivity expansions. And so the price of their product is going down. Their reaction, as we said in a previous presentation, was, well, the reaction is, well, what if we limited the supply? What if we held it until prices boosted back up again? That didn't work very well, okay? Didn't work very well because of the problem of defection. You know, if you guys are going to hold off your supply, I'll release mine, and at least I'll make some. And so this is why we have the deflation of the late 19th century, particularly in the farming sector. They're the ones that get hurt the worst. At the time, you have a dual banking system, and you don't really have, you have a dual banking system now, but not as much with the Federal Reserve. What we mean by a dual banking system is you have some state banks and you have some national banks. Now let's look at the numbers. Again, this comes from Walton and Rockoff, which we've been using quite a bit. And actually, I'm going to be doing it in the summer. I've just found out that I'm probably going to be doing a summer course on U.S. economic history using Walton and Rockoff. And it's going to be a phenomenally good course. It'll be online. It'll be a phenomenally good course. But at any rate, in 1865, you have 349 state banks. By 1900, 322. I didn't work out what the percentage increase there. You can do that on your own. But it's a massive increase. You're talking about a 3,000% increase in banks, with assets going from 231 million to 6.4 billion. Okay, so you have a massive increase in bank liquidity. Now we have to keep in the back of our mind how banking works, just the basics of how banking works. Ask ourselves a question: how do banks make money? Not how do they produce money. How do they earn money? How do they make a profit? Well, banks make a profit by lending out money. This is one of the things I don't like about banks. They don't pay me. I put money in a bank. They don't pay me anything. There are very few interest-bearing accounts anymore. Okay, so they're not going to pay me a thing. Then they take my money, and lend it out to somebody else. Okay, and charge them 5, 6, 7% interest and make money off that. And I don't see any of it. That's why I ought to just do it myself. Become some sort of Shylock, right? I could see myself as Shylock, right? Get myself a couple of leg breakers in case they don't pay it back, right? I could see myself like that. But no. I'm a nice guy. I would never do something like that. But at any rate, yeah. Okay, now with national banks, you see a similar problem, not quite as bad. You had more national banks in 1865, 1294. That will just about triple in number by 1900. And the assets will go from $1.1 billion to 4.9. Ultimately, what does this do? This massively increases the liquidity of banks, which they then lend out. The national government loses control over the money supply. Okay? And so, while they attempted at the early stages to control the money supply, the massive increase in banking as a result of no regulatory control over the banking sector completely contradicted this problem. Okay? And so the supply of money goes through the roof. They start lending out money left, right, and center, and before you know it, they've overlent money. People have overborrowed money. This is all what we've been talking about through the previous presentations. This is as a result of agricultural expansion, as a result of westward expansion and land speculation, as a result of industrial production. So it's becoming more and more of a we talked about the post-war deflation in the efforts to contract the supply of money, especially paper currency prices consistently dropped down. I already referenced lecture 4. I do it again now. Inflation, and this is again what you see here in the second point on this slide is a very basic economic principle. Inflation helps borrowers. It hurts creditors. Why? I borrow money. Okay? When inflation takes place, the money that I pay the bank back is worth less per unit. Okay? If I borrow $100 and inflation of 10% takes place, when I pay the bank back its $100, that $100 is actually worth only $90. So that helps me. It hurts the creditors. That's why creditors charge interest. A bank will always charge interest in excess of the inflation rate. The interest rate up to the inflation rate, if you have inflation of 1% and they charge an interest rate of 1%, they break even. So they charge more than that so they can make some money. Just a little lesson in money and banking. Money and banking is something you kind of have to understand. That's beyond Robert Morris or beyond a history class. You got to understand money and banking just to get by in life a little bit. Otherwise, you get raped. I just got raped because of restaurant. I had to pay $1,500 for flood insurance, and then when I find out, okay, I paid it up front because I hoped that my mortgage would stay at the $416 that it is. No. It's going to go up to the $540 because they've got to escrow the $123 a month this year to pay the flood insurance next year. We're going to get out of that somehow. Okay, now, this is just a basic diagram that I kind of like of the credit system. Just a real basic explanation of it. Okay? Now, what do we see happening here? Let me get my laser pointer so I can explain a little bit. There we are. Okay. Here we have money coming into the bank in the form of deposits, mostly commercial deposits, private deposits. Okay, so think of the bank like it's a tank of water. As money comes into the bank, the level of water in the banking system goes up. When the bank lends out money, it's like opening a drain over here. They open up the drain a little bit, they lend out money. Now, that's not a problem so long as the amount of water or money going into the tank is equal to or greater than the amount of money being drained out of the tank. And you can, and so it's really very much of an art form to do this for banking. This is what the Federal Reserve did. This was what kind of Alan Greenspan did. To a lesser degree, Ben Bernanke. Ben Bernanke was more rule-based. Janet Yellen, who's the current head of the Fed, is kind of a combination of the two. But you can experiment with this yourself. Go to your bathtub and go to a sink, okay, and put the stopper in. Start filling up water. And then when you release the stopper just enough to maintain a constant balance of water. It's pretty difficult to do. You're either going to let too little water out of the tank or too much water out of the tank. It's pretty tough to keep to maintain a steady supply of money at the banks. Okay? Well, in the late 19th century, what's happening? As a result of the reduction in prices, particularly in the agricultural sector, you have less and less water coming into the tank, less and less money flowing into the banks. As a result of agricultural expansion, westward migration, industrial expansion, you have more and more water being drained out of the banks, and so this supply of money gradually dissipates, okay, until it gets to a dangerously critical level. Okay. And this is just an explanation of that, of the previous slide. Money flows into the banks through deposits, flows out of the banks through loans. So long as deposits and loan repayments are equal to or greater than the amount loaned out, the level of bank assets stays the same. This is what we've been going over for the entire time. Industrial expansion, which we talked about in Lecture 2. Farm debt, which we talked about in Lecture 4. Land speculation, Lecture 5. All of this infrastructure development, which we haven't really talked about that much, but as the country expands westward, as farming increases, industrial production increases, this move of urbanization that goes along with that. You have infrastructure development, roads, bridges, railways, the transportation system we talked about at some length. All of these things combined place an enormous strain on the liquidity of banks. Now, what we saw in the previous slide is that the liquidity of banks is going through the roof here, okay, because of the expansion of banking. So they maintain a very shaky balance through the 19th century, but it's all a myth, okay? It's all mythical. There's really not a balance being maintained. Eventually, and it's one of those economic lessons that I mentioned to you before, eventually the piper has to be paid. Placing this much strain on a credit system and maintaining the gold standard so that you have to have some rough equivalency of paper currency to your supply of gold and silver is eventually going to create too much of a strain on the system. It's still not a crisis, though. They maintained this for a very long period of time. They did it recently. They did it, and again, we'll talk about this in Epoch 3, but I'll just introduce it now because it's a very similar situation. You had the last recession was in 91. Okay, then you have Bill Clinton taking over. And Bill Clinton and Alan Greenspan collectively cultivated a very loose monetary policy. Okay? Clinton cut government spending, but there was a loose monetary policy. There was more money in the system. Americans were borrowing money left, right, and center. That's all right. As long as they're paying it back bit by bit, there's not a crisis. Everything goes. Clinton leaves office, Bush comes in. There's a little bit of a warning sign in 2001 that things are not as rosy as you might think. We're going to look at this again in just a few presentations in 1920s. Things aren't as rosy as they seem. You're over-lending. People are becoming over-leveraged. They're borrowing too much money. Eventually, it's going to reach the point where they can't pay that money back. Okay? Bush leaves office. Obama comes into office, and just as Bush is leaving office, the year of the election, 2008, the crisis hits. That's the modern one. Well, this one's going to hit in 1892 and become a full-fledged panic and depression by 1893. Into this mix, we now place the political environment. We have the Greenback movement. We have the rising of the progressive movement, we have the rising of organized labor. Now, one thing that we haven't really talked about is, what is the effect of the organization of labor on this? Well, primarily at this time, it's the late 19th century, primarily what labor's trying to do is argue for better wages and better working conditions. Well, both of those things, better wages, that increases the demand on the supply of money. If you're going to pay your workers more, you're going to need more money to pay them. Okay? If you're going to improve their working conditions 9 times out of 10, the only way to do that is by improving the infrastructure and the logistical support of the facility that they're producing at, which is going to cost you money. Okay? So it's continuing to place a strain on the supply of money. This is one of the reasons that the Greenback movement created and wanted to create more paper currency. Okay? In addition, we have, throughout this period, protectionist trade policies, which we've talked about in a previous lecture. We talked about this in lecture 4. This worsens the farmers' terms of trade. It drops prices. Prices drop continuously through the 19th century, as we saw previously. At the same time, you're increasing the price of manufactured goods. Meanwhile, you have this rising progressive movement, but primarily you have a Republican-dominated government, which is to say you have, at this point in history, a very conservative government. They hold to the gold standard, which creates the problems that we talked about just earlier. Okay, meaning that you're increasing your paper money supply, you're not increasing your gold supply. Paper money is therefore losing its value, and you're going to begin to suffer from inflation. Uncertainty in monetary policy and the future led many depositors to go to the banks to exchange paper currency for gold. As depositors saw the supply of gold, the supply of money rather, going up and up and up by the 1880s, the concern was, as we saw with that numerical example, if we continually increase the supply of paper currency and don't continually increase the supply of gold and silver commensurate with that, the paper currency is going to lose its value. Okay, so if I'm sitting there holding a bunch of paper currency, and I see that they are continuing to increase the amount of paper currency, I'm going to rush to the bank to exchange it for gold, because it's a two-pronged fork. Okay, if paper currency is losing its value, it means that gold is gaining its value. Okay, so as a rational human being, if I have all this paper currency and they're continuing to expand the paper currency amount, my paper currency is going down in value. I'm going to go as quickly as possible as I can to the bank and exchange it for gold. Now the problem is that I'm not the only one thinking this. Everybody that's holding paper currency is thinking the same thing. If we all rush to the bank at the same time, there just simply isn't enough gold there to pay us all off. And so what we're going to have to settle for, as I said in a previous presentation, and as is inferred from that previous slide, okay, if I now have $200, if I originally had $100 and there were 100 ounces of gold, that's $1 per ounce. But if I now have $200 in paper currency, and we all go rushing to the bank together, I'm going to get 50 cents on the dollar. Okay? But it becomes much worse than that. By the time of the 1893 hits, and this is also true with the Great Depression, people are walking away with 10, 20 cents on a dollar. And this is finally the panic of 1893. Situation becomes untenable by the spring of 1893, and in the summer the supply of gold dwindled below 100 million, and that's what creates the panic. Okay, so the after effects of this will be a monetary and financial contraction, a depression. We saw some of the after effects of this. We'll see them again. That's why, among other things, in the discussion of organized labor, this is why in the 1890s organized labor really takes it on the nose. This is one of the main things. It's one of the things actually to address in the quiz, which was, I guess, quiz 2, which was on organized labor. A lot of people missed this point, which was, well, why did organized labor's ranks suffer? Why did they drop? And I think we had 2 periods in the 1870s and 1890s. One of the things that a lot of people missed was it was because of an economic downturn. Okay? When there's an economic downturn, labor doesn't do that well. Because as depression hits and unemployment rises, it increases the supply of the labor force, which makes it harder for unions to hold solidarity. But at any rate, okay,